Welcome back. Joining us virtually this afternoon is our financial expert, Nick Sapienza. Nick, good afternoon. How are you doing today?
Hey, Taylor, doing great.
So today we're talking all about bubbles. So Nick, how do bubbles happen?
So, bubbles can basically be broken down into five steps for the formation and popping thereof, I guess. The first one is displacement. So, bubbles form, the way I think about it is bubbles form when investors overestimate demand for something in the future by obviously a huge degree. They're basically betting that the future is going to look very different from the way it does today, and then people are often consumed by the novelty of whatever that thing is. So it's a new technology or a new floor in interest rates, which kind of planted the seed for the housing bubble in 2008. You can think about what we're seeing with lumber, real estate, inflation, cryptocurrency, et cetera. The fear of future demand can spike current demand. I'm not saying that I think housing is in a bubble. I don't really have an opinion on that. But basically, people are getting ahead of themselves. The future is going to be different, but not as different as we've predicted. I think that's where it fundamentally starts. But then you have other speculators that are driving prices up,
Okay.
short-term traders and whatnot, in hopes of hitting it big. So there are many variables that can cause a bubble to inflate. And then after that first initial stage, you have FOMO kicking in, and that's the boom stage. Prices start rising more rapidly. People are getting in to turn a quick buck. And then you have the euphoria stage, which is basically where the rails have completely come off. The greater fool theory kicks in, which means that I'm buying something in hopes that a greater fool will buy it from me later. And it's at this price where the prices make no sense whatsoever. It'd be like paying $100 for an apple. It's become completely disconnected. And then I guess the apparent signs are that people are making a killing doing this. People are quitting their jobs to day trade, and things are just kind of going too far. So it's after that at some point where profit taking starts to happen, and you see it first. Remember, like big institutions and big traders and Wall Street, essentially, they start taking profits. Red flags start to kind of pile up a bit. I think it's at this stage where like everyone knows it's a bubble, but no one's like really saying that it's a bubble, or maybe they are, but you can't really time it. So
Yeah.
shortly after that, it's kind of like the way I view Dogecoin. Basically, the markets can stay irrational longer than you can stay solvent, as Keynes put it. So the panic is what happens almost immediately after that. Basically that's where all of your short-term novice investors begin a mad dash to the exits. They're selling at whatever price they can get, so you have an enormous supply with basically no demand. So prices fall off a cliff, and the trend is completely reversed at this point. It's counterintuitive, but it's at this moment where you should be buying as much as you can.
Okay.
But rarely does that really happen in practice.
Well, Nick, I feel like I have a whole new meaning for the term word bubble now. Thank you so much for putting
Yeah,
this in financial terms and explaining it for us today. Thank you.
absolutely.
If you guys at home want to rewatch Nick's explanation, you can find it on our website, klaf.com. Before we go to break, though, let's check in with meteorologist Adam Olivier.